So we're looking for the cost of the 9 millionth dollar. First, let's find the cost of debt. The only information that we're given is that current bonds with a coupon rate of 6.2% are trading at par. Well, this means that the return on debt is 6.2%, because we know that if a bond is trading at par, the required discount rate for the bondholders, for the debt holders, is equal to the par value. Since there's no more information about the cost of debt increasing, we can assume that this will be the cost of debt, no matter how much debt we raise. So it doesn't say anything about after we raise $2 million of debt, we have to sell it for a higher amount. It doesn't say anything like that, so we can just say that our cost of debt, no matter what dollar we're talking about, is going to be 6.2%. Now let's find the cost of equity. We're told that we have $5 million to add to retained earnings. If we have to use more than $5 million of equity, the cost of equity will increase. So since our capital structure is 60% equity, the point in our capital budget, CB, where we'd have to issue new equity is the $5 million breakpoint when the cost of equity increases, divided by the percentage of our capital budget that is equity, so divided by 60%. And we get a capital budget of $8,333,333. So if our whole capital budget is more than that, if we're talking about a certain dollar that's past this amount, well, we won't have enough retained earnings to use for equity. We're going to have to issue new external equity. So again, for any budget that's larger than this number, we'll be issuing new external equity and thus incurring those additional flotation expenses that come along with the issuance of new equity. Since we're looking at the marginal cost of capital of the 9 millionth dollar, that's what the question asks, we need to use the cost of external equity for our cost of equity. So again, just to recap, you need to find at what point the cost of one of your components is going to increase using this formula. Here we see it's at the point of $8.3 million. Since we're concerned with the 9 millionth dollar, we have to use the whatever cost is on the new equity. So we can't just look at retained earnings, we have to look at flotation expenses too. Well, recall the equation for the return on equity with flotation expenses. It's the discounted cash flows formula, and it says that the rate of return on external equity, we'll call that R sub E, equals the dividend in period 1, D1, divided by the price today, the price of the stock today, P sub 0, times 1 minus F, where F is the flotation expense. Basically, it's saying every time we sell stock, we don't get the whole price. We get whatever's left after we pay the price of the flotation expenses. And then you add the growth rate as well to account for any capital gains. That's the total sum. The sum of those two components gives us our return on external equity. So this is going to be the cost of stock for us since we have to issue new external equity. Well, we have everything in the question. It gives us everything except for the growth rate. But remember, the growth rate can also be found by multiplying the return on equity times the retention rate. And we do have both of these. So the return on equity is 20%. The retention rate is 1 minus the dividend payout rate, so it's 1 minus the 50%. This 50% is a dividend payout rate. 1 minus that is a retention rate. 0.2 times 0.5 gives us a growth rate of 10%. So now we have all the information we need. The return on external equity is a dividend of $3.60 divided by the price of $60 times 1 minus the flotation expenses. The flotation expense is the 20%. So we plug that in right there, and then we add our growth rate of 10%, which is what we just found. So our return on external equity is 17.5%. That's the cost of equity when we're talking about any dollar after that breakpoint, after that $8.3 million. Thus, as the 9 millionth dollar is 40% debt and 60% equity, which is just our capital structure, we can find that dollar's weighted average cost of capital. Remember, use the after-tax cost of debt, because we have to include that tax shelter. So the weighted average cost of capital for the 9 millionth dollar is equal to the rate of return on debt, 0.062, times 1 minus the tax rate is 40%, times the weight of debt, which is 40%, plus the return on external equity, 17.5%, times the weight of equity, 60%. We get a weighted average cost of capital of 11.988%. And we can also say that this is the marginal cost of capital. This is the cost of raising an additional dollar if we're in this area of $9 million. That's the cost of raising one more dollar when we're around that area. And that's the answer to the question.